This webinar is to give us some thought leadership on what is currently happening in the world of private equity, and also in support of our executive education program, which is 5 days in Oxford and runs next in February. So please contact us for more details on that. Today we have Professor Tim Jenkinson, who is the program director for the executive program, also director of the Private Equity Institute at Saïd Business School. Been researching private equity for 15 to 20 years now, and a member of the Private Equity Research Consortium, which is a group of academic researchers from some of the top schools around the world working together in this field. We're also lucky today to have Chris Kallos join us. Thank you, Chris. So Chris is a partner at Kirkland and Ellis, one of the large corporate law firms working in this area, recognized internationally as one of the leading attorneys in this space, and particularly working in the areas of M&A, financing, fund structures, etc. So thank you, Chris, for dialing in from the US. Our topics today are, as you'll see in front of us. We'll go through these in about 35 minutes or so. As we go through, please do enter any questions which you have into the question box or the Q&A box at the bottom, and then that will allow us 10 minutes or so to address any questions from the group at the end as well. So we have a good number of people signed up, and we have probably a good amount of people kind of coming online now, approaching 100. So around about this time, I think I'll pass over to you, Tim, to take the conversation forward from here.
Great. Thanks very much, Steve. This is an annual event for us where we sort of review what's going on in the private equity sector and what's been going on over the last year and where things are going in the future. And quite a lot's been happening this year. And what I wanted to do was to start with some of the macro trends that are affecting the industry and then go into some of the more specific issues. And so it's great always to have Chris Kallos here. Welcome, Chris, to our annual chat. Unlike me, Chris is sitting there doing deals every day of the year, and so is ideally placed to know what's going on in the sector at the moment. And so what I wanted to do was start, Chris, with the sort of what's going on in the fundraising side of things. How's it looking? I know feels like it's been a slower year this year for reasons that we'll come on to, but is that the right perception?
Yeah, in terms of getting funds closed and wrapped up, yes, it's been a bit challenging. In terms of activity, people are very busy, so it's sort of a challenging environment, but not slow in terms of activity itself. The number of funds kind of closed in 2024 is down from 2021, 22, and 23. So fewer funds getting closed, larger average fund size. So people are still raising funds, hitting their targets. Sometimes those targets are more modest than maybe what they would have thought a few years earlier. But it's active, but it's hard to say it's there's not champagne corks popping every few minutes in fundraising right now. Getting to that final closing is more of a slog than it used to be. Probably around 24 months to get to a final closing. That used to be closer to 18, and I mean back in the day more like 9 to 12. But in recent history, 18 has now become 22, and then now 24. So it's a bit of a slog.
And I'm interested in what you say about fund sizes getting larger, even as it's quite a challenging fundraising environment. This relates a bit to some of the research I've been doing on like what happens when the market matures and you get more sort of big brands out there who are able to raise lots of money and what that does to the sort of risk and return. We won't go into that today, but by that because is this becoming a sort of brand name industry where it's actually quite difficult to raise money at situations like this if you are a first or second time fund? Is that what this data is sort of telling us?
Well, it's always been a bit of a binary market, right? So folks that can raise money can raise a lot of money. They can raise it, maybe it used to be able to say they can raise it very quickly. I think the very quickly part is moderating. But if you can raise money, you can raise money. If you can't, you can't. That's always been the industry. I think no one's looking to get into the bottom half of the performers. That said, it's an industry where everyone's coming up with new ideas. And as you said, the larger funds are both growing organically. Obviously, if you run a profitable fund and people give you X and you return, 1.8, 2.2, 2.8X, there's more capital for those investors to re-up with you. And so some of it is that, but some of it is a concentration on names that the LPs are comfortable with. So re-upping more with existing managers, and existing managers are offering more and more products to make that easy for LPs to do. And in some cases, acquiring essentially other managers that have a product line that fills out their offering. So yes, there is kind of a flight to a more concentrated group of managers, but there's still, we're working on first-time funds all the time. So first-time funds are still getting done, but it's kind of bucking that trend.
Yeah, maybe one of those mean median issues, isn't it? That the mean fund keeps going up and the median fund size may be a lot lower, as we see in many of these sorts of where we have very skewed distributions. That's what we see on returns. It's a bit of a segue, but you see that the mean return on the fund is much higher than the median because it's all driven by the best deals in a fund. And here you have a few $10 billion funds, and it skews the mean way beyond the median. So the things could actually be consistent, actually.
Yeah, I think I would probably, and this is anecdotal, but I would bet that some of that is newer funds are getting raised at small sizes. And some of those newer funds might be for existing managers. So that new product line that comes out is not going to come out as a $5 or $10 billion fund. And so, that's probably messing with the data a little bit. So some of these kind of new product lines for existing managers, and the fact that I would agree that kind of, ramping up very quickly as a small fund, investors usually like to see your first fund's returns get pretty solid before they want to commit to your fund, let's call it 3. And so those first 2 funds, I think, are probably not starting out as big and not ramping up as fast as, you might have expected. And so I think that's also probably in your data. So I think there are probably a few things going on.
Yeah. And what about the economics of the funds? Are we seeing much change in 2 and 20? I know that the larger funds, it hasn't really been 2 and 20 for a while. It's been more like, I don't know, 1.75 and 20 or something like that. But have you seen any easing of that in this difficult or slightly more challenging fundraising environment?
So I think that pendulum doesn't swing that far in one direction or the other. So there always, 2 and 20 is kind of the catchphrase. The 20 is very sticky. That 20 typically, if we're focused on buyout and growth equity, that 20 typically comes with an 8% preferred return. That number is, surprising to some, very sticky across long history of interest rate changes. So that part, the 20%, the 8% pref, the American waterfall for American funds has been pretty stable. The fees have the market has caused there to be an increased attention to fee discounts or fee holidays. So things where either everybody at the beginning of the ramp up doesn't pay that full fee, they pay something less, or more commonly, early closers or very large closers are getting some kind of fee break. It's interesting that you said that it's more like 1.75 for large funds. Maybe somewhat counterintuitively, the threshold where people start talking about coming down from the 2%, in other words, the fund gets larger, let's say it's 500 million, then $1 billion, then $1.5 billion, then 2.5. I would say it used to be that once you got somewhere between $1 billion and 2, there was a lot of pressure to come down from 2%. We've seen quite a large number of large funds keeping that 2% around a bit longer. So we're seeing 2%, all the way up. I mean, for some folks, that can dictate their terms, they're kind of outliers. They might have 2% at very, very large funds. But for a more typical fund, we're seeing lots of funds at 2% at 3 billion plus, maybe even up to 5 billion. So that number is pretty sticky. Occasionally, we're seeing folks even raising, if they had really low fees historically for some reason, looking to raise them a bit. But I think overall, you're right on the trend. There's pressure to reduce the fees as the fund size get larger, and in a tough market, that's usually the economic element that gets played with to bring people into that first close or early closes and to bring people in size.
Yeah, it's interesting. One of the things that has changed in the last year, which I'll give a little bit more information on in the course, is that there's starting to be, in the UK, there's been a lot more transparency about these fee levels. There's started to become data available across LPs to show how they differ, the terms differ in funds, because there's been a regulatory intervention in the UK, which is a so-called cost transparency initiative. It's very interesting to see that there is perhaps more variation in the fees that the investors pay than many in the academic world had realized. So I'll be including a bit of information on that in the course, actually, because it's an interesting emerging area. Anyway, what about other aspects of the? I know that the sort of LP-GP relationship. Is there the last few years there's been a clamoring for more co-invest and the like, and things which basically reduce the cost of the relationship to the investors. Is things carrying on in that direction?
Sure, there's a lot of focus on co-invest, and there are a lot of co-invests being offered, and there are a number of things driving that. One is what you mentioned, which is the typical reason that LPs are clamoring for co-invest. They're trying to reduce their economic costs. Typically, at least historically, co-invests have been largely either reduced fee and carry, or if you go back far enough, no fee and carry. I would say the trend is towards economics on co-invest. So it is becoming very common to get economics on co-invest, so both fee and carry typically. Sometimes that fee is relatively low. The carry tends to be, depending on the co-invest, it might be 10%, it might be 20%. It could be even scaled up beyond that based on, high preferred returns, essentially, or multiples of money. So co-invests are out there. They are, increasingly charging economics. In addition to satisfying that LP need, it's also addressing somewhat the difficult fundraising environment. So if you think that the fundraising environment is really difficult, you may want to stretch the capital that you have in that existing fund by bringing in more co-investors into deals so that, you don't have to go to market when you're not maybe ready to go to market. You want to go to market kind of before you need the money, but you also want to go to market with the best story that you have. And so if you've got some realizations that are getting stretched that, you thought they were going to happen in 2024, now they're going to happen in 2025, you may want to wait a little bit to go fundraise. And one of the ways to be able to give yourself that flexibility is to have more co-investment. And, reduced economics, just so everyone understands, it's reduced economics, but it tends to be individual deals, right? So, even if you're paying 10% carry on a deal, if you don't offset any losing deals against winning deals, then that might not be a great deal for the LP. But I think you've done some research about there not being adverse selection in co-investments. So all things being equal, investing in every co-invest at a reduced economics is probably a smart strategy.
I mean, that is what the evidence seems to show, certainly from the research that I've done, but I would still be very wary of investing in deal by deal, like co-investments where the carry is deal by deal, because you're not offsetting the losers against the winners, are you? So that seems to me, if economics is starting to be charged, that really does, certainly on the carry side, it certainly reduces the attractiveness, I think, to the LPs.
Particularly on higher risk investments. So a lot of these are, one of the reasons they're attractive is they're not particular, people want to be in them. They may be more stable companies, or, at least the people in them think they're going to do very well. But if you were going into something that had a higher variation in performance, where you could reasonably expect a significant number of losers, then yes, I would be very wary of that.
Yeah. Now the second main area here is on distributions, like what's been happening to giving the money back to the LPs. There's been a bit of a sort of logjam, I would think, in terms of, if you look at the amount of money being distributed out of the funds, the deals seem to be being held on for longer. There's less exit opportunities, and we've had one question in already saying, do you think that the IPO environment's going to come back in 2025 for greater distributions? Not that IPOs are the only way to do it, but anyway, what's your sense? It's a little bit crystal ball gazing, but do you get the impression there's lots of deals that are sort of oven ready, waiting to go?
I think there's some reassuring news here. I think yes. As you know, there's the old saying, you can't eat IRR. It turns out you can't eat money multiple either until it comes out in cash. But I would, and I know this is being recorded, so maybe I'll regret these words next year when we do this. But I would get your wire transfer instructions ready. I mean, I think distributions are coming. Multiple things are pointing in that direction. We've got more stability and reasonableness around rates. It's easier to transact in a sort of more certain environment and also a lower interest rate environment. The political and economic instability seems to be moderating. I mean, we've got, for better or worse, we have an election in the United States. We have a result. We know who the president's going to be next year, and the communication around the agenda for that president and his administration gives people, I think, some things to work with on predicting where taxes are going to go, what economic growth is going to look like, where the focus is going to be. So, again, it's easier to transact when you have less risk around your predicted outcomes. Conflicts around the world. Also, I think people think there's probably more chance of those moderating. We've got a president coming in who seems more oriented towards reducing conflicts, promising to reduce them incredibly quickly. We'll see what happens. But all those kinds of things, I think, point maybe towards an ability for buyers and sellers to meet on price. There's plenty of dry powder for buyers to do deals. The sellers definitely, know their limited partners want distributions. So the general transactional environment, I think, has multiple arrows pointing towards getting more deals done. We're seeing that kind of in the prep to get deals done. In addition, the IPO window, as the participant asked about, those things don't stay closed forever. I think there's been a shift in companies staying private longer. I think there was a recent Wall Street Journal article maybe yesterday about the pressure for employees getting their wealth from startups, et cetera, turned into cash is being alleviated from some of these tender offers within those companies. But still, the investors do want to get cash at some point. And, there's a whole industry built around IPOs. And now that we've got kind of this additional certainty, I think we're going to see that window opening. I think it'll stay open for a good part of the year. So, I would predict lots of IPOs in the middle part of this year. There are plenty of companies sizable enough for IPOs. I had the data, but I didn't bring it. But the number of IPOs and the number of unicorns, so $1 billion plus private companies, has grown astronomically over the last 5 years. And so, in theory, any of those could go public, and some of them will. And then you've got, as I said, a whole industry. iBanks have to iBank. There's folks that are going to, the only way they get paid is to get these things done. And so, everybody, I think, wants these transactions to happen. It's just been difficult to have, all the things that need to come together, including buyer and seller's view on price and on forecasts. I think those things are, coming closer together, and we'll see a lot of transactions.
Yeah. No, it's interesting. I think these things do have a habit of freezing for a while and then they thaw. I'm being curious as to how it will thaw, whether it'll be mainly, corporates buying from the private sponsors or sponsor to sponsor deals, which seem to have gone a bit quiet, or whether it'll be through the public markets. Or indeed, we've had a question about dividend recaps and whether we might have dividend payments coming out of these. If nothing else happens, these are pretty, you could borrow more money against some of these businesses and ship it to the GPs that way. But it's a big question. But where do you see the balance coming in the next few years, next month or so?
I recall there being some famous advice about, if you're going to give predictions, don't make them too specific. So I would predict distributions with some level of confidence. How exactly we get there, I think it will be a mix of a lot of those things. There are already plenty of incentives to do the dividend recaps, and I think we've seen some of that happening. But I don't know if that will be if these other things, these other paths to liquidity are available. I don't know that would be the preferred path to liquidity. I think there's plenty of companies that the existing sponsor is probably ready to sell. We've seen continuation funds, which I'm sure we'll talk about later, as an escape valve for that. But I think that's, in a continuation fund, that same sponsor still needs to raise the money, maybe from a different pool of investors. But there are sponsors out there who already have capital raised, ready to deploy, and I think there'll be a lot of those transactions, in the coming year.
Yeah. Let's go on to the political side. You've touched on it already with the US, and obviously viewed from Europe, it's a mixed bag here. You've got the relative stability of the UK with a majority government that won't be toppled for a few years, and then you've got countries like France and Germany where things are very, very uncertain. So it's not, but obviously the US is by far the largest market for private equity. So it looks, again, it looks stable there with a sort of with a presidential result announced, again, for better or worse, and the Senate and the House going in the same direction. So is it really like that sort of constellation of everything pointing in the direction of the Republicans, which everybody thinks is going to be 2 years of bonanza, and then who knows what happens? But is that what people are anticipating?
I mean, it's very hard to predict exactly what will happen on the front of what laws get passed, despite the Republicans having, a majority. That doesn't mean that everything that they might want is going to happen. I think there's and again, put aside any views people have on the individuals involved. There are a lot of controversial and public individuals involved in. Not just the administration, but around the administration and appointments to various cabinet positions, et cetera. Some of them have been controversial. If you kind of don't get into the weeds on that and just think more broadly about what people are kind of expecting, I think there's an excitement in private equity for a more pro-business climate. I think have been felt like there have been headwinds being manufactured by the government to lots of the progress that some of these firms and their companies are looking to make. And so, a generally pro-business climate, I think folks have some hope and excitement for, that, may or may not come to pass. But I think that's, from a private equity investor perspective, a positive. This DOGE, this Department of Government Efficiency concept, is completely new and unproven, but potentially very pro-business, pro-private equity in a variety of ways. First of all, change by itself creates opportunities, and private equity is all about finding opportunities and new ideas and capitalizing on them. Efficiency and a lower U.S. debt load. It sounds very positive for what a lot of the private equity firms are trying to accomplish. Rethinking maybe from first principles, as the folks running the Department of Government Efficiency are looking to do. Reducing regulation, bringing more sensible regulation. That's a very pro-growth idea. So all of those things, I think, are viewed positively by the private equity industry. I think having a more friendly tax posture. So we've had quite a number of years now of slogans: tax the rich, corporates have to pay more, fair share. Lots of not as much of it has gotten done as has been kind of threatened, but facing that kind of government posturing on how they're approaching tax, I think makes things more challenging. Seeing some easing of that. Again, I'm not expecting massive change, but the lack of I think the tax environment now is fine for private equity. So if it doesn't change, that's probably a positive. If it actually gets more permissive, a more friendly posture, even better for private equity. But the fact that it's unlikely to get worse over the next couple of years is a positive. In more emerging areas, where I think there's been some criticism of the approach of the current administration. We've got a more crypto-friendly administration, a more startup-friendly administration. You're seeing that, at least for now, the president's seeking counsel from folks in that industry. I think that's creates some excitement that there will be a pro-growth, as opposed to painting folks as villains. painting folks in the industry as part of the solution, part of growing out of some of the challenges that the country has. In specific areas, energy demand, is going to be an exciting spot to be. The president-elect is pro, energy, I think, broadly. And the need for energy, has had a step change with the advent of AI and its power demands, and the increasing, I think, view of AI as being strategically important in the US and abroad. And so I think I would expect a lot of increased energy demand, and that creates opportunities. And I think the president-elect is pro-energy and pro-energy here. And so I think that will be kind of an interesting opportunity for the US, but I think also abroad, between the war, between AI's strategic importance, I think you're seeing a lot of countries more focused on energy independence and how to get there, and the need for reliable energy for their industries, but also with an eye on not getting left behind in AI and what that would mean in terms of energy demand. Space is an interesting area that I think is been in the news a lot lately. I think the president-elect is pro that industry. He did create the Space Force last time around. We've seen, kind of more and more examples of the importance of space for a variety of industries, and I think that's an interesting area. And then AI generally, I think, is a pretty exciting area. I think there's also a lot of hype around some of these early companies, but it's hard to, I think, argue, at least maybe I'm just not informed enough to argue against the importance of the trend overall. And the capital demands for that in that industry and the adjacent industries are,
Huge.
large.
Yeah.
Let's
Come on to AI.
yeah, they're not small.
Yeah, because I just wanted to just check up one thing. So that all sounds great. If I was private equity executive in America, I think I would feel pretty bullish at this stage. But on the other hand, there is the so-called, the uncertainty about tariffs, isn't there? And whether on two grounds, you can imagine a situation where you've got a portfolio company, it's got quite a heavy export bias, and you don't quite know which way it's going to go with tariffs. That could be really bad for it, especially if it's exporting to certain, countries which are potentially in the firing line, which I thought was going to be China and a few others, but now I realize it's Canada and other places like that. May not be so, that might be a worry. And I suppose the other worry is, and I know that this isn't the narrative that I've heard coming out of not out of the political side of the US, but tariffs may put up prices, which may put up interest rates, or at least keep interest rates higher for longer. Do you hear concerns about either of those things?
Tariffs are the big asterisk wild card in all of this. So both, first of all, I believe, at least, there's a lot of bluster around it. I will see what actually happens. I think there's a certain level of showmanship. I'm not necessarily saying they're looking to have other countries kiss the ring, but I think the idea of I think Trump's idea is that there should be kind of more respect for probably him personally, but also sort of the role of the U.S. and the size of its market. And, he probably has a long list of things that he thinks are underappreciated. And so I think that's his, something that's at least partially in his control, that he can wheel out as, effectively a threat. I don't think that there are going to be prolonged dumb tariffs. So I don't know enough about trade policy, et cetera, to be able to say what that means practically. But I think it's a self-correcting thing. So I think that if there were, large and dumb tariffs, they wouldn't last very long. But I think there'll be a lot of talk about tariffs, and probably some will get imposed somewhere. I'm not particularly worried that Canada's going to have 100% tariff associated with it. So we'll see where that goes, but that could change, as you noted, I think very correctly, everything that I said in the last 10 minutes. Like that, that wild card, I don't think anyone knows exactly how that would play out if it were used at scale, but it could change all of those things.
Yeah. The other thing, well, you mentioned AI, and which is hard to avoid, but I was, as you know, I teach my executive MBA students twice a year in Silicon Valley, and this year, everybody who came through the door, all the guest speakers said that, most of what they're focusing on is AI. To many people, that was very inspiring. To me, being a cynical and older, not cynical, skeptical, older person who's seen many of these before, that worried the hell out of me. Because if everyone's investing in something, you normally know that the returns are not necessarily going to be very good. How do you feel about this? Is this, if an AI-focused fund came through the door, would you be reaching for the checkbook?
I would be doing diligence, but I would have a checkbook out of my drawer, yes. So I think that I'm not deep enough into AI to be able to pick exactly the opportunities that I would invest in. I think there are lots of people that are going to be proposing a lot of opportunities, and I think they're all going to be interesting to look at. I think there are a few big companies in various ways approaching, artificial general intelligence and trying to get there before everyone else, and thinking of that as, you win that, nothing else matters. And I don't know if they're right or not. I don't know how close they can get to that or how fast. Some of it can be a little bit scary. That's a very kind of big boy game. That takes a lot of capital and a lot of engineers, and a sway with the few key chip manufacturers to get a lot of chips, and also get a lot of power. And there's lots of things that have to happen in that space, but there are a lot of people who view that, or a number of people who view that as an existential kind of situation. And so there's going to be a lot of focus specifically on that. I don't know how many presumably somebody is going to get very far, if not all the way down the path there. And I don't know how many winners there can be there, but there are definitely investment opportunities around that. But there's also investment opportunities all around more vertical AI integration. So AI to make, transform industries, make things that work, not work, make other things that couldn't work before work. And so I think from, services industries to manufacturing to, it's hard to imagine an industry where having, kind of human or superhuman intelligence deployed by machines in that industry is not going to make a significant difference. So I think it's going to be a very transformative technology over the next, several years. And there's going to be lots of change caused by it, and that will create investment opportunities. There'll be people who lose money as well, right? Not everyone's going to make money off of this. And not only will they lose money because they invested in the wrong thing, they'll lose money because their company got disrupted by some of these new companies. And so I think that the focus and the hype around its importance is all, to me at least, and again, I'm not an expert in the space, but seems justified. Whether or not it's justified, it's going to be, a massive focus in the private equity space broadly. Whether you're talking about these large language models and the pursuit of, general intelligence, or whether you're talking about, very defined use cases within industries, et cetera, there's going to be a lot going on. And then you got the adjacent stuff, as I mentioned before. Energy is, I think it's hard for us, having lived our life in the century that we've lived it in, to think about the energy demands for something like this and what that would mean in terms of, how we're going to address it. You've got the background increased energy demands of a global population that's modernizing, et cetera, electrifying. But now you add this, very power hungry element that's going to change perhaps where we get energy from, where we deploy it. The huge cluster that XAI is doing is in Memphis, Tennessee. There are probably plenty of people on this call who didn't know there was a Memphis, Tennessee, or certainly would have trouble finding Tennessee and certainly Memphis on a map. But now it's in the news every day because this is happening there. I think that's going to be happening in the Gulf. I think it's going to be happening in, Europe. I think countries are going to view the need to have some capability here as being, a national priority. So, imagine all that energy demand, all over the world on top of what we already have. So I think there's going to be a lot of change, a lot of investment opportunities. And there'll be winners and losers, but I think there'll be enough change that you can't ignore this in any industry. It needs to be something you're focused on.
Yeah, no, completely agree. It just that, as we all know, that when there's lots of investment in certain things, it can be good for consumers and not for investors. Think cheap energy, think green energy.
A lot of money will be burned up.
Super cheap.
A lot of money will be burned up in this pursuit, right? There'll be a lot of money spent on things that either don't work or work not as well as somebody else's thing, and that somebody else's thing may take the whole share of whatever it is you were trying to get done. Yeah. So yes, I think there'll be a lot of money spent that will advance the overall cause for consumers, the world, governments, etc. But some of that will not be earning a positive return.
Yeah. Now, I want to move to some of the more micro things. So, and we've got some questions coming on the chat I've seen. I wanted to ask you about GP stake sales, where they've been selling stakes in the general partner, which we've spoken about for a couple of years here. But we've got a question here about whether that's going to continue, and how those are linked into other deals which are being done. So what's your perspective on what's going on the GP stake sale side?
I think they are and will continue to be a very active and important area of this industry. I think that historically it's been primarily minority stake sales. And I think it'll continue to be the majority of the deals that are done. I think it's affecting the industry. To just for a second jump to one of your related points, it drives behavior in the sponsors. And so if you're thinking about the value of your firm, which 30 years ago, people didn't think about there being any value in the firm. It's like, okay, we're a bunch of folks that came together, there are values in the funds, and then, eventually we'll stop doing this, and there's not like an enterprise value in the firm. Obviously now people view there as being enterprise values in these firms. If your view is that to build enterprise value in your firm, to make your firm more valuable in anticipation of potentially selling some or all of it in the future, you want to play towards the things that the buyers value. And the thing that gets the most value is recurring revenue. So think fees. And so, a growth in fee-oriented products like credit products, infrastructure products, et cetera. And also, potentially, if you ask me what might change in the economics, I think that sponsors, even of equity funds, will be looking for fee-based products for their equity funds, because that's what's rewarded in these stake sales. In terms of the stake sales themselves, again, the minority stakes just by number will continue to be, I think, the majority thing, the deal that's being done. For many firms, that might be a second or third stakes deal. So they sold 10 or 20% initially. They may do another round and sell another 10%. I think the newer stuff is you're seeing, I think, more majority stakes deals getting struck. So managers who are looking to round out their product offering by actually, rather than build a credit manager, or rather than build a real estate manager, they'll bolt that on in an acquisition of one sort or another.
It's the BlackRock type deal with buying lots of different houses and creating their own house overnight almost.
Yeah, I think it's a way to accelerate. If you want to get in, this is a way to get in quickly. And for those that can write the checks, I think you're going to continue to see some of those majority stakes deals happening. The other thing is for folks that are looking to raise capital for a specific purpose. So let's say a firm was going to do a minority stakes deal 2 years ago because they wanted to get some house capital, if you will, to launch new products. And so they wanted to be able to launch 4 new products over the next few years, and they needed to have a GP commitment around that to do it and to bring on a team, et cetera. To raise that capital, or they had a succession issue, right? So they've got a retiring group of partners, and the younger partners want to buy out the older partners, but they don't have the capital yet to do that. Having a third party buy a stake of the firm from those retiring partners is a way to get them cash, et cetera. So those minority stakes were a solution to those problems. I think they still are, but I also think there's increasingly available preferred equity solutions to those problems. So effectively a lender, whether it's debt or equity, but for purposes of this, think of it as a lender who's going to give you a bunch of capital to do all these things and want a return on that and get it back, but doesn't need to own part of your firm. So it's a form of financing these kinds of activities that I think is becoming more available and more attractive. I think the actual stake sales is viewed as expensive in a very quickly growing firm. Like if you're right, and this is a positive investment and it's going to grow the value of your firm, you're giving up a portion of that value, which is uncapped. Not an uncapped portion, but an uncapped value to a buyer versus having a more limited financing cost.
Yeah, it sounds like another example of what we discussed in the course, Chris, where I think you came up with the term, like if in the private equity industry, if there's an unlevered asset, it'll probably get levered, and it seems like another example of that. But a couple more quick fire ones here before we wrap it up. We've talked a lot about continuation vehicles where the GP continues to sort of own an asset, wants to hold on to one of its best assets, and rather than sell it to another fund or to an M&A or something, actually holds on to it into a special purpose vehicle, which LPs can choose to go into or not. What's going on there? Are they still very popular? Are they changing in any way? But what's going on in that space?
I think they remain popular. They're viewed as legitimate, acceptable paths to liquidity for investors. I think in a slow deal environment like we've been in for a little while, they've been a very important kind of component of getting DPI, so distributions to paid-in capital, out to investors. How necessary they are as we move forward in a more normalized deal environment, I think it will no longer be kind of the preferred solution to getting liquidity as a more general matter. Like, hey, we're going to do some of these deals because we're getting a lot of pressure from LPs to get liquidity, because you can get liquidity in other ways. But it'll continue to be an important element, because there are plenty of cases where the sponsor, the GP, does want to get the next turn of growth out of that company, but it's been long held in their fund. And so rather than selling it to someone else who thinks that they're going to get 2.5 times their money, the GP would rather get 2.5 times the money itself by transferring it to a continuation fund. That said, a lot of those investors in the funds, the folks providing the capital to make these deals happen, are looking for more stable and possibly a little bit lower. So risk-adjusted returns that are perhaps a bit below what the regular private equity investors are looking for. So if you're really going to get like 2.5 times your money in a few years on a deal, you shouldn't really have to go to that capital source that's to raise the money for it. You should be able to raise the money from regular way investors. So we'll see how that, once the deal environment normalizes, I think you may see some changes in continuation funds, both in terms of who's providing capital, because they're a bit capital starved. There's not enough money right now to do all the deals that could be done. So there might be a change in kind of who provides the capital. There also might be a change in one of the other kind of limiting factors, is the LPs may make it easier for themselves to participate on the buy side of those continuation funds, either having a dedicated sleeve inside their operation or making it easier for them to do the things that are otherwise challenging. So lots of LPs have a bias towards selling in these transactions, and that's in part because they may have divided their actual assets into a series of vintage funds, and it's hard for the 2018 fund to kind of re-up. And it's also difficult for the 2024 fund to buy something that was in a 2018 fund. There may also be, not all of these LPs have the ability to diligence in a way that gives them enough confidence, diligence these opportunities. They're used to diligencing fund, blind pool fund opportunities where you're diligencing the manager. Here you're diligencing the company itself. So there's things that drive LPs to selling in these transactions. I think the other way that it might change is LPs start addressing some of those issues, making it easier to underwrite a re-up. that would have a number of effects, including reducing the capital you need to raise from these third parties for these deals, and allowing more of these deals to get done, which is, part of the, even though there are lots of continuation funds, most participants would say there's just not enough. And that's it's a capital constrained area. So I don't know if you want to talk about like reasons people do them or other things about it, but I think they'll continue to be important.
Yeah, I think it would be great to, but we've sort of run out of time. I think that continuation vehicles are becoming into the next generation almost, where you see the big, some pretty chunky funds being raised just to do continuation vehicles. So we're going to have funds of continuation vehicles before very long. So, but these are some of the things we can also discuss in February. But I'm sorry we didn't manage to answer more of the questions coming in on chat. We've slightly run out of time, but there's a lot going on in the industry at the moment. And so thanks ever so much, Chris, for bringing us up to speed. As always, very interesting and informative, and perhaps a slightly more interesting environment now, even than it's been for the last couple of years, with the sector maybe coming out of its slightly sort of sleepy period, with changing political environment. But with that, thanks very much, Chris. I'll hand it back to Steve, just to finish off the webinar.
Thank you, Tim. Thank you, Chris. So yeah, thank you again for your time today and for your insights over the last 45 minutes or so. Thank you also to everybody who's joined us over the last 45 minutes or so. We've had a really good turnout and lots of good questions. Actually, we unfortunately couldn't get to many of those on the Q&A and the chat. So sorry about that, but hopefully some of you will be able to join us for our executive program in February. So the next program runs 10th to the 14th of February, 5 days, in-depth program, in person in Oxford, led by Professor Jenkinson. Chris Kallos will be here with us as well for the first 2 or 3 days. And then we also have another half dozen or so senior industry guests from across the industry, a couple of different funds, law firms, advisors, and banks to talk about what transactions they are seeing and working on, and to help people put their strategies together for the next for the coming years. If you would like to join us, you can do so by looking at the website. There's a QR code where you can quickly scan that and get there now. That will also give you contact details for my colleague Clara Blackings-Pollard, who will be very happy to answer any questions that you have regarding admissions or application for the process, or please reach out and happy to advise anything like that. Once again, thank you everybody for your time in joining. Thank you, Chris. Thank you, Tim, and hope to see you all again in February or next year. Thanks again. Bye-bye.